Hello, my name is Carlos McWhorter, CPA, and this is Roadmap to Wealth. And this channel is about gaining a greater understanding of investing and wealth management so that we can have something to guide our decision making. Now, here's a phrase that you've probably heard before, and that is all investing assumes risk. Risk is involved in every investment decision that you make. It's just how you mitigate that risk that determines whether that's a wise investment decision or not. Now, one thing that I've learned about risk is all about proximity, how you're positioned to the risk. And one thing about finances is that you can look at life's examples or life scenarios, and you can typically apply that to financing or investing and vice versa. So imagine that there's a volcano eruption that's getting ready to happen. You only have risk depending on how close you are to the volcano. If I am not on the island that the volcano is on, the chances of me being harmed are very slim. If I am on the island, then my risk has increased. If I'm on the volcano, the danger is imminent. So like I said earlier, all investing assumes risk. Risk is involved with all types of investing. So when we invest in stocks, one of the main risks that we are concerned with is called capital risk. And capital risk is basically the risk that the security that you put your money in loses value and the price of your capital, the price of your equity goes down. So basically losing money in a stock. Now, Buffett said there are two rules to investing. Number one, don't lose any money. Number two, don't forget rule number one. And sound investing is about investing in a way that reduces risk. So you want to mitigate those risks. If you are avoiding risk, that means you're not investing at all. So we're not trying to avoid risk. We just want to mitigate that risk and make sure that we're investing in securities that the risk is minimal, that we are going to lose money. And if you properly manage risk, the gains will take care of themselves. So like in the scenario with the volcano, the highest risk would be being on a volcano when it's about to erupt. When it comes to investing, that would look like investing in companies that are not quality, that don't have a profit, that don't have strong revenue growth, that don't have any type of competitive advantage in their market that they compete in. Investing in those companies is assuming a whole lot more risk than you probably want to assume. So when it comes to investing in quality companies, you have to look at the financials. You have to learn how to read the financials and determine whether the company is good or not. There are many companies that are popular and that get a lot of buzz and a lot of attention in the media, but just because people are paying attention or talking about that company doesn't mean that that company is even making money, let alone has a real competitive advantage. So let's look at a few companies and dive right into their financials and take a quick look at companies that were very popular over the past few years. And let's look at their financials to see if those companies are even making a profit. So the first company we're going to take a look at is Uber Technologies. So looking directly at Uber Technologies consolidated statement of operations, basically this is the income statement. So it shows for any particular period of time the money that came in and how much money is left over after expenses and the cost of doing business. So looking at the revenues, we see that in 2019, they have 13 billion in revenue. 2020, they have 11. And in 2021, they have $17.4 billion in revenue. This is very strong revenue growth. I will say that. However, looking at their financials, looking at this line, the loss from operations, we see that this company has not made any money yet. They still are operating at a loss, meaning the company has not figured out how to bring in money and run their business in such a way that there is money left over after all of their expenses. So as we see year after year, they have a loss. So when a company has a loss, that means they're operating off of either investments that came in or they're taking out loans or taking out debt to fund their operations. Now, one thing to note, from year to year, that loss is getting smaller, so they are getting closer to profit. But when you invest in a company, you're taking a risk because you don't really know how long it's going to take them to get to profitability. You can look at their growth and make estimates, but as we know, things can go south for a company at any moment. So you're assuming a risk by making that estimate versus investing in a company that has a long track record of being profitable. Another company that was widely popular over the past few years is Peloton. So let's look at their income statement really quick. Now, as we see, looking at the 2019, 2020, and 2021 numbers, top line revenue, they have grown their company significantly as far as looking at the top line revenue. However, we can jump straight down to the income or loss from operations right here. It says loss from operations. If they had income, it would say income or loss, if there was both, or just income from operations. But as you see, it only says loss because over the past 3 years, this company has not made a profit. And unlike Uber, that loss was getting smaller, so we can see that they're getting closer to profitability. But here we have 2019, $202 million of loss, $80 million of loss, but then they're back to $187 million of loss. So looks like they were doing better in 2020, but not so well in 2021. Even with more revenue, they're back to a almost $200 million loss. Here is a quick investing lesson. When you're looking at companies to invest in, make sure that the company is operating in a normalized environment and judge off of the numbers and the results in that environment. With Peloton, that company was so popular in 2020 because everybody was home. So it worked. But unfortunately for them, as soon as gyms started opening up, gym membership went right back to where it was before the pandemic, which means this product was great when everybody was at home in an environment that wasn't normal. But as the environment began to normalize, as you see, this company ran into a lot of trouble. Another company is Palantir. Now, I really like the company. I like their future outlook, and I mean way in the future. I'm not really sure about when they'll be able to make a profit. So let's look at Palantir real quick. Looking at the 2018, 2019, and 2020 numbers, again, looking at the top line revenue, they pretty much almost doubled their revenue in 3 years, which is amazing. However, looking at our line that we like to look at really quick, the loss from operations, they still have a loss. Not only do they have a loss, that loss is getting larger. $623 million to $576 million to $1.1 billion loss. So look at this. Palantir in 2020, the amount of the loss was greater than their income. So they spent everything that they made and more. And again, that means they are funding their business with cash flow from debt or cash flow from investors, new investors coming in. They're not running their business off of cash flow from their business. Another business that was, again, wildly popular over the last few years, and might have been the business that introduced you to investing, as it has done so many other people, is Robinhood. Looking at Robinhood's financials, we see that in 2019, they had $277 million in total revenues. In 2021, they have $1.8 billion in revenues. Awesome growth over the last 3 years. So looking at these financials, they don't have a line that says loss from operations, but they do have a line that says income or loss before income tax. So this is basically their loss or gain from operations. So looking at 2019, they had a loss of $107 million. 2020, they had a gain of $13.8 million. So that's pretty good. But look at 2021. Robinhood lost $3.6 billion in 2021. What are they using to fund the growth of their business? Now, a lot of newer companies are in this position where they're using debt and equity to fund their business because they just don't have the cash flow. And that's not a problem. That is normal. But when you invest in those companies in the early stages, you're assuming a lot of risk. You don't know when that company is going to grow. You don't know how soon they'll get to profitability. You don't know if they'll be able to maintain that profitability. I'm not saying that these are bad investments. I'm just saying that investing in these companies in the early stages, you're assuming a lot of capital risk. You really don't know if the company can support their current valuation for a long time. And when it comes to investing, I don't care how great the charts look. Always look at the financial statements to understand the investment. So you might be asking, how do I avoid this risk? How do I avoid capital risk in the market when I invest? You avoid this risk by investing in quality companies. There are 5 main factors that I consider when I'm looking at a company to determine if that company is a quality company or not. Now, these are not the only factors I look at. These are just kind of like the 5 initial things that I look at. And based on these factors, it lets me know if I'm even interested in looking at this company even deep. Number 1, stable revenue growth. If you put your money into the market, you're putting your money in there to grow. So you definitely want to have a business that's growing. Very simple, common sense concept. You put your money into businesses that are growing so that business can help grow your investment. Number 2, margins. You definitely want a company with healthy gross and operating margins. You want a company you can invest in companies that are not making money from their business currently. They could be early stage and they could be awesome businesses. However, you're assuming risk. So to avoid that risk, make sure you're investing in companies with healthy margins. Number 3, returns on capital. You want businesses to make great money from the amount of capital they put in. Now, this capital is either debt of course, borrowing money from another entity that they're putting into their business, and equity, either money that they've raised through selling shares or money that they've actually created from running their business. That's a part of the equity. So when they put debt and equity back into their business to create a return, you want that return to be high. So high return on capital. Now, leverage. You want a company to utilize debt, but utilize it in a very wise way, in a way that's good for the company. So you want a company that is properly leveraged. I say you want a company that has debt that is no more than about 3 to 5 times their free cash flow, money that they are making from their business, and pay off that debt within 3 to 5 years. Number 5, free cash flow. You want companies that are producing free cash flow and are actually growing their free cash flow. Much like that revenue, you want a company to be growing their free cash flow year over year very strongly. The free cash flow is what the company is going to use to pay down their debt, pay out dividends to the investor, make acquisitions, and continue to reinvest in the company to grow the business so that the value of your investment will grow along with that business. So you definitely want companies that are producing a positive free cash flow. So that's my wrap up of what I consider a great company or a quality company to be. And we want to invest in these types of companies to avoid the capital risk of losing money in the market. If you found this video helpful, please consider hitting that like button and subscribing to my channel. I have so much more coming to you on the way, and I'm very excited to produce this content to hopefully guide you in your decision making so that you're making wise decisions as you're building wealth for your future. Thank you.